Hello and welcome to the February fund update for the Pure Income and Growth Fund and the Pure Resources Fund. I'm Nick Berry, Portfolio Manager and co-founder of the funds. Equities retreated in February. The RBA's first rate cut since 2020 failed to appease markets as trade tensions, tariffs and inflation concerns prompted widespread selling, and stagflation became increasingly front of mind for markets. The All Ords Accumulation Index fell 4% for the month, with selling continuing in recent weeks. In fact, at the time of writing, the index is down a further 2.8% in March. Similarly, the Small Cap Resources Index declined 3.7% for February. In this context, the Income and Growth Fund posted a modest decline of 0.5% in February, and the Pure Resources Fund a comparatively modest 0.4%. For the Pure Income and Growth Fund, performance was driven by the decline in a single stock position, being DXN, which fell 26% for the month, albeit on less than $500,000 of stock traded. We remain big believers in DXN's story and expect its share price performance will correct over the coming month or two. Partially offsetting the decline in DXN was a gain of 65% in Spacetalk for the month, and with our warrants now in the money, any further performance in Spacetalk share price becomes a positive contributor to fund performance. And finally, after several delays, a portfolio position, Wellnex, has completed its dual listing in the UK, resulting in a return of $2 million of capital to the fund and an overall IRR on the investment of 14%. Pure Resources Fund performance was largely driven by a decline in the share price of Comet Ridge, which has been experiencing some post-capital raise indigestion since it accessed fresh equity capital in December. The weakness in Comet in recent months has been largely offset by interest income in the fund, but it is the reason for the fund's flat start to 2025. Commenting more broadly on the Resources Fund, although returns have been tepid of late in absolute terms, our commodity exposures of primarily gold, gas and tungsten are serving us well in turbulent times, underpinning the fund's continued substantial outperformance of the index. Key portfolio position Kingston Resources continues to make good progress at its Mineral Hill site in New South Wales. The plant is running exceptionally well and gold production continues to lift. With the Aussie dollar gold price above $4,500 per ounce, it's a good backdrop to improving cash flow on site. The company's Missima asset in PNG is up for sale and investor interest has been good. A value unlock here could be a real share price driver, and it's one to keep an eye on. More broadly, we think resources markets will continue to show volatility for the next few months. Nevertheless, we see investor and market interest improving in commodities and are optimistic that the independent catalysts within our portfolio are coalescing towards solid absolute as opposed to relative performance this year. Finally, a comment on large versus small and micro cap performance of late. Investor interest in small caps, especially smaller small caps, has been navigating cyclical but also structural headwinds for many years now. In terms of the former, there is evidence to support the idea that a rotation out of highly priced large caps into undervalued small caps is occurring. As we have said, we believe the cycle has turned, but it still has a long way to go after a sustained and unprecedented period of large cap outperformance. This growing improvement in relative performance is in part due to M&A activity in small caps, particularly smaller small caps, the waning confidence in large cap exceptionalism, and the expectations of lower interest rates. We wrote in an earlier newsletter about the fact that interest rate cuts tend to have a disproportionate impact on small caps, albeit it typically takes at least 3 cuts before any material outperformance can be observed. The RBA cut the cash rate by 0.25% in February, and bond markets have priced in at least 2 further cuts in 2025. Based on our analysis of the last 4 rate cutting cycles going back to 2012, this will be sufficient for both strong absolute and relative returns in the small cap indices. In our view, however, there is also a structural issue. The question we must ask is, who are the incremental buyers of small and micro caps? Those that are still focusing in on real small caps, i.e. the 1,700 stocks outside the top 300, have had significant capital outflows. 2 stalwart managers in this part of the market are believed to have suffered a decline of more than 70% in funds under management in their primary small cap funds in recent years. In this month's newsletter, we take a look at the factors that have taken an alternative, traditionally large cohort of small and micro cap buyers out of the market, namely younger generations of investors, and how certain emerging headwinds to recent global mega investment trends may see this structural headwind begin to correct. For now, though, there is one segment of buyers for microcaps and small caps, and that is corporates. We noted in last month's newsletter that M&A engagement continues with various positions in our portfolio. We have tracked 43 takeovers of smaller small caps since the beginning of 2023. This does not include mining or property companies. The average takeover premium has been 96%, compared to the long-run average of around 35%. We wonder, how much longer are individual investors going to leave this value on the table for strategic acquirers? Thanks for watching, and we'll see you again next month.